Some of the atmospheric conditions you mentioned there are at least similar. And by the way, yesterday was the 11th anniversary of the stock market top in 2007. Now, that doesn't really mean anything except that it also was kind of a very marginal new high after having reached one a few months earlier, which is what we got in the past few weeks. But there are significant differences, and a lot of them have to do with some of the issues that are really preoccupying the market right now. Obviously, interest rates being one of them. So I think the market is apprehensive about what the bond market is saying in terms of yields being pushed up. But it's also made the yield curve that we were so concerned about a little bit steeper. The yield curve had been flat and just about inverted by the time the market topped in 2007. It had been actually a couple of years coming where housing had buckled and credit indicators had started to flare up in a big way well before that. We're not seeing that now. The credit markets are very firm and seem like they're in pretty decent shape, so not really setting a message of economic weakness. However, within the stock market, the message is very mixed. If you looked at the 52-week low list yesterday, it was housing-related stocks, home-building-related stocks, it was auto stocks, also asset management. So it seems, and semiconductor equipment names as well. So it seems like the market's taken on this defensive tone. I think you can still keep in mind the possibility that all we're seeing right now is a kind of a pause in the market, a stealth correction. You have the average stock down close to 10%, even though the indexes are within about 2 or 3%
Where were interest rates back in 2007?
They were up in the sixes, I would say. The long-term rates, like 5 to 6. I mean, that's how the Fed had raised rates at every single meeting for a couple of years going into 2006.
Right.
And the long end didn't really move, and so you had flattened it out pretty
because
well.
there was inflation, though, in a way.
Well, there was inflation, there was a fear of inflation, there was a fear of a housing bubble, and so that was considered to be, housing and oil were considered to be these two sources of potential inflation.
Yeah, the super spike in oil prices.
Yeah.
In terms of the comparison differences, and when we also consider the epicenter of the last crisis being the banking system,
Exactly.
banks are infinitely stronger than they were then, and their share prices haven't run away in the same way that they had in 05, 06, 07
Yeah,
either.
I mean, by 06, financials were the largest sector in the market because those stocks had done so well. And part of the story I'm telling on credit is that there's not a systemic lending issue. There's not a solvency issue.
It's not 40 to 1.
So I don't even think we should be even talking about that particular episode. Except, even if you go to prior cycles, when you have super low unemployment, when consumer confidence is extremely high, if you look out a few years, usually you have a little difficulty because you have to come off those levels.
Valuations?
They're okay. They actually weren't very expensive in 2007 based on the earnings we thought we were getting.